Welcome to Stock Talk with Nico Criticos. Today we're going to be going through Kinder Morgan stock, ticker KMI. This is one that I have not purchased yet, but I am thinking about it. And so we're going to use Nico's stock market checklist to analyze this. And the first thing on the list we're going to look for is if the stock is it down or is it oversold? And I put no because today the stock is a little over $17. And the 52-week low is 13 and the high is 19. So it's definitely more on the higher range of things. And just a month or two ago, the stock was trading at $15 and now it's 17. But I mean, this is not a super volatile stock. It looks like it normally stays, right around this $18, $17 mark. So this is it's more of a safer company to be invested into, but it definitely could fall a little bit more. I would much rather buy it at a price like $15 or $16, but we'll see. Then next up on the list, we have the revenue and net income numbers. Have they been increasing? No, they have not been. If we look here, we can see that revenue has actually been going down and net income has been going down. So that's not a great sign. Now, since this is a business that's based off of commodity products like oil and gas, any type of stock that's related to the commodities are going to be, they're dependent on how the commodity price is doing. And those do fluctuate. So that is something you got to watch out for. If we look at the last 12 months of revenue, we can see that, so I guess, so it's the past 12 months is up. It's at $15 billion versus $11 billion last year, but the years prior it was decreasing. So that's not a great sign. So we're going to give those a no. As far as the valuation metrics of price to sales and forward price to earnings, we're going to give those a yes, because a price to sales of 2 is cheap, especially considering in the past. Well, it looks like it normally trades right around this 2 to 3 mark. So, but that's very cheap. Forward PE of 15. That's a little bit under where it's been trading in the 17 to 19 mark. So a forward PE 15 is also pretty cheap. Once again, this could go, this stock could go down, but it's definitely not overvalued right now. Is the company innovative or does it have a moat? This one is a little bit tricky because there's different ways you can measure this, and you kind of have to be an expert in the industry to really be able to tell, but I'm not. But one thing I would consider a moat is that they are North America's largest natural gas they have the largest natural gas transmission network, and it is the largest independent terminal operator, and it has the greatest CO2 transportation capacity in North America, and it's the largest independent refined products transporter. But the bottom line is they pretty much have 40% market share in their industry. So they have 40% of natural gas consumption and exports, which that's pretty much a moat, because not anybody can just walk in there and become the dominant player in North America gas transportation. So I'll consider that a moat. That is something that's not everybody can achieve. Next up, growing industry. I put yes. I know there's different ways to measure this too. You can say that since more people are going towards renewables and they're going to try to use things like electric and solar, and yes, that is true, but that's before the United States is primarily using renewable energy, it's going to be a while. And I think the estimates I've seen have been like 20, I want to say 20, at least 20 years until for the next 20 to 25 years, we're going to be using gas and oil to power most things. So you have that, but not only that, you also have the fact that a company like Kinder Morgan, they know that the renewable energy thing is the future as well. So they acquired several companies in the past year to help them in that industry. And I mean, they know where the future is, and they're working on creating renewable sources of energy. So that's also not a problem. They're probably going to be here to stay. Next up, return on invested capital. This number is 4.8%. So not the greatest. That's why I put no. Healthy margins, I put yes. A profit margin 11% is very nice. Then we come to healthy cash flow. I put no. It was very sporadic, kind of similar to the revenue. And then we have diverse revenue streams. I put no. I mean, you could say they do transport several different types of materials, and they also have terminals and stuff. So you could say that, you know, they transport gas, they transport oil, the CO2, all these different things. But really, they just have one business model. It's to transport these commodities, and they're really only making money one way, through these subscriptions and charging people based off how much material they transport through those pipes, through the pipeline. So that's really the only way they make money. I wouldn't count that as diverse revenue streams. For the balance sheet, I put, yes, they do have more long-term assets and liabilities, but they do not have more current assets and liabilities. So that's going to get a no. And then equity at the same, that's also the equity over the past couple of years has not been increasing. So if we look here, we can see total equity. It's gone from 34 in 2018 down to 31, and now it's under 31. So that's not good. Next up, a share buyback or a dividend. This is really the main reason I'm interested in this stock. This is the only thing that I'm interested in. Is it's low volatility and high dividend. That's really all I'm looking for, and at least a healthy dividend too. I don't want a high payout ratio, but a dividend of, what are they paying? 6.2%, and a payout ratio of 138%. That's not good. That's not good. But that is going to be dependent on their cash flows. So if we look at their cash flows, you can see that operating cash flow for the last 12 months, 5.7 billion. And see, end cash position is not great either. It was 1.2 billion a year ago. Now it's 277 million. But if we look here, you can see that cash dividends paid $2.5 billion worth, and they did 5.7 in operating cash flow. So that's not horrible. 2.5 billion in dividends paid, and how much do they do in income? Let's see, it's probably net income 1.7. That's why. So they did. See, that is kind of high. They are paying a lot in dividends, but that could just mean if they're raising the dividend, that could mean they're very confident in future cash flows. But yeah, 1.7 billion of net income for the last 12 months, and they paid over 2 billion. That's a little bit too much. I don't think that was a good idea. But I mean, I don't know. We'll see what happens with that. As far as the share buyback goes, their share change pretty much didn't change much. Is big money interested? Yes, there are many big hedge funds that own this. So all in all, we got what? 1, 2, 3, 4, 5, 6, 7, 8, only 8. So technically this would not pass my test because it needs to have 10. But this is just one stock I was looking at, just because I'm looking for a place to store a lot of money that I can have low volatility, don't have to worry about share depreciation, but I'm looking to have at least a 5% dividend. And so this one pays a 6, which is good. And this should be a pretty, a non-volatile company, but there might be something better out there. So I'm going to keep looking, but yeah, that is Kinder Morgan for you. So let me know what you guys think down below. If you guys think this is a good place to store your money for a dividend, then tell me what you think. See you in the next video.